There's a 5-story building on Grand Cayman called Ugland House. It sits at 121 South Church Street in Georgetown, about a block from a beach. From the outside, it looks like a mid-rise office park you'd find in any small American city. A parking lot, a few palm trees, glass and concrete cladding. Inside that building, according to the Cayman Islands Corporate Registry, is the legal home address of approximately 40,000 companies. That number is not a typo. 40,000 corporate entities, including subsidiaries of Coca-Cola, Procter & Gamble, General Motors, Intel, FedEx, Sprint, and a long list of hedge funds and private equity vehicles, are registered, on paper, at this one 5-story address. They do no business in Cayman. They have no employees there. The actual law firm that occupies the building, Maples & Calder, has as staff. The 40,000 companies do not. They exist on filing cabinets and digital registers. In 2009, then-President Barack Obama gave a speech in which he held up Ugland House as Exhibit A in what he was calling a crackdown on offshore tax abuse. Quote, "Either this is the largest building in the world or the largest tax scam in the world." It became one of the most quoted lines on tax avoidance in modern American politics. What's interesting is what happened next. Nothing, or more precisely, the opposite of nothing. When Obama gave that speech, Ugland House was the registered address of about 12,000 companies. Today, 15 years later, the figure is roughly 40,000. The building is the same size. The number of corporate residents has more than tripled. This is the part most people miss when they hear stories about tax havens. The system isn't a failure of regulation. It isn't a loophole nobody noticed. It is a working piece of global financial infrastructure that has continued to grow in plain sight across multiple presidential administrations, through multiple international reform efforts, despite an entire genre of investigative journalism dedicated to exposing it. Every few years there's a new leak. The Panama Papers in 2016, the Paradise Papers in 2017, the Pandora Papers in 2021, and every time the system absorbs the headlines and keeps growing. So today I want to walk you through how it actually works, not as a moral story, as a technical one, because the architecture is more interesting than the outrage, and once you see the architecture, the headlines stop being mysterious. We're going to start with how corporations do this, then move to how wealthy individuals do it, then to how celebrities do it, and then we're going to land somewhere that surprises most people, which is the United States, because it turns out the biggest tax haven on Earth right now isn't on a Caribbean island. It's in a state next door to Pennsylvania. We'll get there. Let's start with the basic concept. An offshore company is a company registered in one jurisdiction whose actual business operates in another. The Cayman entity has no office in Cayman, no employees in Cayman, often no server, no telephone line, no physical presence beyond a filing cabinet. The company is incorporated there, and that is the entire point, because incorporation determines tax residency, and tax residency determines which government gets to tax the profits. There are 4 jurisdictions that dominate this market. The Cayman Islands has about 84,000 residents and roughly 118,000 active companies, a ratio of about 1.4 companies for every Caymanian. There's no corporate income tax, no capital gains tax, no personal income tax, no withholding tax. You can incorporate in 24 hours. The British Virgin Islands, with a population of about 31,000, has approximately 366,000 active companies. That's about 12 companies for every BVI resident. Bermuda specializes in reinsurance. Many of the largest reinsurance companies on Earth are technically Bermuda entities. And Hong Kong, while not strictly a zero-tax jurisdiction at 16.5%, functions as the preferred gateway for capital moving between mainland China and the rest of the world. Outside of these 4, you have a second tier. Jersey, Guernsey, the Isle of Man, Luxembourg, Malta, Cyprus, Singapore, the UAE, each of them specialized in a slightly different niche of the same business. Each of these places earns the majority of its GDP from financial services. Cayman gets roughly 70% of its economy from finance. The local population is mostly employed servicing the offshore industry. Law firms, accountancy practices, registered agents, trust companies, fund administrators. The islands aren't tax havens by accident. They are tax havens by design, by deliberate national strategy, in the same way Switzerland built itself around banking secrecy, and Singapore built itself around shipping and trade. Now, an individual person can register an offshore company directly, and many do, but the real volume comes from multinational corporations. And to understand how a multinational uses one of these structures, we need to look at the most famous example of the last 20 years, which is Apple's Irish setup. For roughly 2 decades, Apple operated a tax structure that the accounting world named with surprising honesty, the double Irish with a Dutch sandwich. It involved 2 Irish companies, 1 Dutch intermediary, and a destination in a zero-tax jurisdiction. Apple had 2 subsidiaries in Ireland. One, called Apple Sales International, sold iPhones and other products into Europe, the Middle East, India, and Africa. The other, called Apple Operations International, held most of Apple's non-US intellectual property, patents, designs, brand rights, software licenses. Here's where it gets clever. Ireland used to have a quirk in its tax law where corporate residency wasn't determined by where you were incorporated, but by where the company was actually managed and controlled. So Apple incorporated Apple Operations International in Ireland, but held its board meetings in Bermuda. Under Irish law at the time, that meant the company wasn't Irish resident for tax purposes. Under Bermuda law, of course, Bermuda doesn't tax corporate income at all. The company was, for tax purposes, a resident of nowhere on earth. When you bought an iPhone in Paris, the money didn't go to Apple's French subsidiary. It went to Apple Sales International in Ireland. Apple Sales International then had to pay royalty fees to the company that owned the patents, which was Apple Operations International. Those royalty payments were enormous. They typically consumed around 90% of European profits, because the brand and the technology were valuable, and Apple was free to set the price of an internal license to itself. The Dutch sandwich was added because if Apple had transferred the royalty payments directly from Ireland to a non-EU jurisdiction, Ireland would have applied a withholding tax. But under EU tax treaties, transferring funds between 2 EU companies, say, from an Irish entity to a Dutch entity, was exempt from withholding. The Dutch was routed Ireland to Netherlands to Bermuda. The Dutch company existed purely as a conduit. It often had no real employees. At the end of this circuit, profits sat in Bermuda, untaxed. The European Commission's investigators eventually calculated that Apple's effective tax rate on European profits in 2014 was 0.005%, not 1%, not 0.5%, 0.005%. To put that in context, if you bought a can of Coca-Cola in Berlin, the value-added tax you paid on that single can, in percentage terms, was higher than what Apple paid on billions of euros in European profits. In 2016, the European Commission ruled that this arrangement constituted illegal state aid. Ireland had given Apple a tax benefit unavailable to other companies, which violated EU competition law. The Commission ordered Ireland to recover 13 billion euros in back taxes from Apple. And then something strange happened. Ireland refused to take the money. The Irish government joined Apple's appeal against the Commission, arguing that they didn't want the 13 billion euros. That sounds absurd until you do the math. Apple employs around 6,000 people in Ireland. Around them sits an entire ecosystem of tech companies, Google, Meta, Pfizer, dozens of others, who chose Ireland in part because of its low corporate tax rate of 12.5% and the discretionary deals available on top of it. If Ireland accepted the 13 billion euros, it would be admitting that those deals were illegal, which would scare off the rest of the multinationals. Ireland was choosing future tax revenue over a one-time windfall. A small country competing on tax policy needs the appearance of stability more than it needs the actual cash. In 2020, Ireland and Apple won the first round. The EU's General Court ruled that the Commission hadn't proven its case. Apple celebrated. Ireland celebrated. The story looked over. And then, on September 10, 2024, the European Court of Justice, the EU's highest court, overturned that ruling. It was the final appeal. There was nowhere left to go. Apple had to pay. The 13 billion euros, plus interest accumulated over 8 years of escrow, came to about 14.4 billion euros. Apple recorded a one-time income tax charge of approximately $10 billion in its 4th fiscal quarter of 2024. Ireland, the country that had spent a decade fighting to refuse this money, was now legally required to accept it. I want you to sit with that for a moment, because it tells you something important about how this game actually plays out. The Apple case was not a victory of regulation over evasion. It took 8 years of litigation, 3 rounds of court appeals, the highest legal body in Europe, and the cooperation of a country that didn't even want the win. And by the time the courts caught up to the double Irish, the multinationals had already moved on. Ireland itself had changed the law in 2015 with a phase-out period that ran to 2020 to retire the structure for new arrangements. The IP that used to sit in Bermuda now sits in places like Jersey or has been re-domiciled to the United States to take advantage of a 2017 American tax provision called GLTI that lets U.S. companies pay a relatively low effective rate on foreign intellectual property income. So Apple is the prestige example. But the technique Apple used, moving profits between subsidiaries by manipulating the prices of internal transactions, has a name, and it's used by basically every multinational on Earth. The technique is called transfer pricing, and the cleanest illustration of how it works isn't actually Apple, it's Starbucks. In 2012, a Reuters investigation looked at 14 years of Starbucks UK financial filings from 1998 to 2012. Over that period, Starbucks sold around £3 billion worth of coffee in the United Kingdom and opened 735 stores. Across those 14 years, the company paid a grand total of £8.6 million in UK corporate tax. That's a tax rate of approximately 0.3% on revenue. And Starbucks, in its UK financial statements, said the reason for this was that it had been losing money the entire time. 14 consecutive years of opening new stores in a country where it claimed to be losing money on every cup. When the UK Parliament hauled Starbucks executives in front of the Public Accounts Committee, the MPs were apoplectic. One of them, Margaret Hodge, more or less asked, "Are you running this business as a charity? If you've been losing money for 14 years, why have you opened 735 stores?" And the Starbucks executive, with what I can only describe as professional calm, said, "Yes, we have genuinely been losing money. The cost structure is high." So let's look at the cost structure, because Starbucks UK was not, in fact, losing money on coffee. Starbucks UK was sending money to 4 other places, and what showed up on the UK books was the residue. First, the coffee beans. Starbucks stores in the UK did not buy their coffee directly from growers in Colombia or Ethiopia. They bought it from Starbucks Coffee Trading Company, a Swiss subsidiary. The Swiss company bought green beans from farmers, marked them up substantially, and then sold them to the UK stores at the marked up price. Why? Because the Swiss corporate tax rate, at the time, was around 12%, and the UK rate was 24%. By routing the beans through Switzerland, Starbucks moved most of the gross margin on coffee into a lower tax jurisdiction. The UK stores were paying a premium for their own company's coffee. Second, the brand. Starbucks UK paid a 6% royalty on its total revenue to a separate Starbucks subsidiary in the Netherlands. In exchange for the right to use the Starbucks brand and trademarks, the Netherlands had a special tax regime that gave preferential treatment to intellectual property income. The brand royalty was effectively a way to siphon roughly 6% of UK turnover into a low-tax intellectual property holding company, where it sat largely untaxed. Third, the interest. Starbucks UK's store expansion was financed not by Starbucks corporate equity, but by intra-company loans from Starbucks subsidiaries in lower tax jurisdictions. Reuters documented that Starbucks UK was paying interest rates on these internal loans that were substantially higher than the market rate the UK retail bank would have offered. The interest expense reduced UK taxable income. The interest income, conveniently, was received in a place that taxed it very lightly. Fourth, management fees. Starbucks UK paid a generic global management services fee to Starbucks US headquarters. What did those services consist of? Strategy support, brand maintenance, IT services, global procurement coordination. What were they worth? Whatever Starbucks said they were worth, because there was no market price for Starbucks' own internal coordination services. By the time you stacked those 4 mechanisms together, Starbucks UK's books showed somewhere between 0 and small losses. The transfer pricing absorbed everything. And here's the thing, every single one of those individual transactions, viewed alone, was defensible. Of course you pay for the coffee beans. Of course you pay for the brand. Of course you pay interest on debt. Of course you contribute to global headquarters costs. The trick wasn't in any one transaction. The trick was in the cumulative effect. When the story broke in 2012, there was a public boycott. Protesters gathered outside Starbucks stores in central London. The PR damage was severe enough that Starbucks made what it called a voluntary contribution of £20 million to HMRC, the British tax authority, over the following 2 years. They were very careful with the language. It wasn't a back tax payment. It wasn't a settlement. It was a voluntary gift. The structure remained in place. Starbucks UK still pays its Swiss subsidiary for the coffee, still pays its Dutch subsidiary for the brand, still pays internal interest on its store expansion. The architecture didn't change. They just bought peace. That whole episode, the Starbucks story and the Apple story, concerns how corporations move profits across borders. But there's a parallel system with similar mechanics that operates one level down. It's the system that wealthy individuals use to move and store their personal wealth. And the structures it uses are not subsidiaries and royalty payments. They are trusts and foundations and shell companies and family offices. The destinations are the same: Cayman, BVI, Jersey, Switzerland, Singapore, but the architecture is configured differently. We have a fairly detailed picture of this individual layer because of leaks. In October 2021, the International Consortium of Investigative Journalists published the Pandora Papers, a leak of 9 million documents from 14 offshore service providers. The leak named more than 35 current and former heads of state, more than 330 politicians and senior public officials across 91 countries, and over 130 billionaires. King Abdullah of Jordan was revealed to have spent approximately $100 million on properties in Malibu, Washington, D.C., and London through a chain of BVI and Channel Island shell companies. The then Czech Prime Minister Andrej Babis was shown to have purchased a chateau on the French Riviera through a shell structure. Tony Blair and his wife saved several £100,000 in property taxes by purchasing a London office building through a BVI company, then dissolving the company afterwards. One particular case from the Pandora Papers tells you a lot about how the system functions in practice. There's a Florida woman named Mary Estelle Curran. She was 79 years old when she was prosecuted. She had inherited a fortune and parked roughly $43 million in offshore accounts that she had not declared to the IRS. She pleaded guilty. She was facing more than 3 years in prison. The federal judge in her case, Kenneth Reiskamp, sentenced her to 1 year of probation, and then, in the same hearing, revoked the probation, setting her free. He went on to suggest that she should apply for a presidential pardon and called the prosecution a waste of money. She walked out of the courthouse a free woman. Compare that to many other tax cases we'll discuss in a moment. In the United States, the most comprehensive look at how wealthy individuals manage taxes came from a different leak. In June 2021, ProPublica published an investigation based on a trove of leaked IRS data covering the tax returns of thousands of the wealthiest Americans across more than 15 years. The investigation focused on the 25 richest Americans. Between 2014 and 2018, those 25 people saw their collective wealth grow by approximately $401 billion. Over those same 5 years, they paid a combined total of around $13.6 billion in federal income tax. ProPublica calculated what they called the true tax rate, the ratio of taxes paid to wealth gained, and it came to 3.4%. For comparison, a typical middle-income American household pays around 14% of their income in federal taxes. The richest 25 paid 3.4% of their wealth growth. The individual numbers were even more striking. Jeff Bezos paid no federal income tax in 2007 and again in 2011. In those 2 years, his Amazon stock was rising dramatically, but his reported taxable income was low enough that he qualified for, and claimed, a $4,000 child tax credit. Elon Musk paid no federal income tax in 2018. Warren Buffett, over a period in which his wealth grew by $24 billion, paid a true tax rate of 0.1%. George Soros went 3 consecutive years without paying any federal income tax. Michael Bloomberg paid 0 federal income tax in several recent years. The point I want to make about these numbers is that, almost without exception, none of this was illegal. Bezos didn't hide income. He just didn't have much of what the U.S. tax code defines as income. The technique that powers most billionaires' tax minimization in the United States has a name. It's called buy, borrow, die. It works like this. A founder accumulates wealth in the form of company stock. That stock might increase in value by billions of dollars a year, but unrealized capital gains aren't taxed under American law. You only pay tax when you sell. So the founder doesn't sell. Instead, when the founder wants to spend money, to buy a house, to fund a lifestyle, to invest in something new, they borrow against the stock. Banks are happy to lend at very low interest rates against highly liquid, highly valuable collateral. Mark Zuckerberg, in 2012, took out a 30-year mortgage of around $6 million against his Facebook stock at an interest rate of 1.05%. Larry Ellison has, at various points, had personal credit lines against his Oracle stock worth billions. Loan proceeds are not taxable income, they are loans. So the founder lives on borrowed money, never sells the stock, never pays capital gains tax, and then they die. Under American law, when assets pass to heirs at death, the cost basis is reset to the market value at the moment of death. This is called step-up in basis. All the unrealized gains accumulated over a lifetime simply vanish for tax purposes. The heirs can sell the stock the next day with no capital gains tax liability. The estate may pay an estate tax, but with proper structuring through trusts, that can be reduced dramatically too. Buy, borrow, die, 3 steps fully legal, and they explain almost everything about how American billionaires pay so little tax. Now, that is the system for the very richest. There's a different system that has gotten a lot more press, which is the system used by celebrities. Celebrities have a problem most billionaires don't have, which is that their income comes mainly in the form of cash payments, performance fees, endorsement deals, image rights, which are very hard to disguise as anything other than ordinary income. So the techniques they use tend to be more aggressive and more often illegal. And because they're famous, when they get caught, the consequences are public. The blueprint case in many ways is Wesley Snipes. In the late 1990s and early 2000s, the actor earned around $38 million across multiple films. He stopped filing tax returns entirely from 1999 onward, on the advice of a group of anti-tax activists who told him that U.S. income tax wasn't really legal. He filed a fraudulent claim seeking $11 million in refunds. In 2008, he was convicted of 3 counts of willful failure to file federal income tax returns. He was sentenced to 3 years in federal prison. He served his time, was released in 2013, and as of several years later was still facing federal tax liability of more than $20 million. A different style of case came out of the UK around the same time. In 2012, the British comedian Jimmy Carr was named in a Times investigation into a scheme called K2. K2 was a tax avoidance structure based in Jersey, the Channel Island, in which a participant would funnel their UK income through a Jersey-based shell company. The Jersey company would then lend the money back to the participant. Loans are not income, so no income tax was owed. The reported tax rate of K2 participants, according to the Times, was around 1%. Jimmy Carr was sheltering an estimated £3.3 million a year. When the story broke, then Prime Minister David Cameron publicly called the scheme morally wrong in an interview, naming Carr specifically. Carr issued an apology, withdrew from the scheme, and paid a settlement. What's important about Carr's case is that K2 was legal at the time. It was tax avoidance, not evasion. The K2 architecture was eventually closed by HMRC, but Carr was never prosecuted because he hadn't broken any law that existed when he was using the structure. The international image rights cases are a third variant, and they come almost exclusively out of European football. Spain has been the most aggressive jurisdiction in pursuing these. Lionel Messi was found guilty of tax fraud in 2016. The case centered on his image rights, which had been assigned to a chain of shell companies in Belize, Uruguay, and the United Kingdom. The income from his image rights, endorsements, brand deals flowed to those offshore companies, which paid almost no tax. Spain charged him with evading approximately €4.1 million over 3 years. He received a 21-month suspended prison sentence, which was upheld by the Supreme Court in 2017. In Spain, first-time nonviolent offenders can avoid actually serving prison time on suspended sentences under 2 years, so Messi never spent a day in prison. He paid the back taxes and the fine and moved on. The Cristiano Ronaldo case followed almost exactly the same pattern. In 2018, Ronaldo agreed to plead guilty to 4 counts of tax fraud related to image rights income that had been routed through a BVI entity called Tolan Associates and an Irish holding company. The Spanish tax authorities had calculated that Ronaldo had evaded around €14.7 million in taxes between 2011 and 2014. He settled for a payment of €18.8 million and accepted a suspended 2-year prison sentence. He did not serve time. The most recent high-profile celebrity case is Shakira's, and it has an unusual ending. In November 2023, on the literal first day of her tax fraud trial in Barcelona, Shakira agreed to settle. Spanish prosecutors had alleged she failed to pay €14.5 million in taxes between 2012 and 2014 by claiming she was not a Spanish tax resident during those years. The argument was that she had spent more than half of each year in Spain, was therefore resident under Spanish law, and owed Spanish tax on her global income. Shakira maintained she'd been touring, and her primary residence had been in the Bahamas. The settlement involved a fine of approximately 7.3 million euros, plus an additional 438,000 euro fine, and a 3-year suspended prison sentence she did not serve. She said she settled to protect her children from the stress of a public trial. And then, in May 2026, a Spanish appellate court ruled in her favor in a separate case involving subsequent tax years. The court found that the Spanish tax authorities had not actually proven she was a Spanish resident in 2011. The government was ordered to refund her approximately 55 million euros plus interest, around $64 million in total. She had paid the 2023 settlement, but on the broader question of residency, she eventually won. After almost a decade of accusations, she walked away vindicated. I want to add one more case because it points to something specific. The musician Lauryn Hill was convicted in 2013 of failing to file federal tax returns on approximately $1.8 million of income earned between 2005 and 2007. She was sentenced to 3 months in federal prison and served the time. What's relevant is that as recently as 2024, the lingering financial damage from her tax case forced her to cancel a planned Fugees reunion tour. The IRS continued to claim arrears against her. A tax problem from 20 years earlier was still distorting her career. What you see across these cases is a hierarchy. At the corporate level, with proper legal structuring, you can pay 0.005%, and the worst case is a court order to pay back taxes. No criminal liability for executives. At the wealthy individual level, with buy, borrow, die, and good lawyers, you can pay 3.4% on wealth gains and never face prosecution. At the celebrity level, where the cash flows are too obvious to disguise, you often end up with prison sentences, though usually suspended in Europe, and only actually served by people who, like Snipes and Hill, made aggressive choices about not filing at all. Now, everything I've described to this point involves money flowing offshore. Caribbean islands, Channel Islands, Switzerland, Luxembourg. And there's a natural assumption people make when they hear all this, that tax havens are a foreign problem, that the United States is the country chasing this money, that if we just got tougher on Cayman or Bermuda, the problem would be solved. I want to challenge that assumption because the reality is much stranger. The single largest beneficial owner of anonymous shell companies on Earth, by a substantial margin, is the United States. The Tax Justice Network publishes something called the Financial Secrecy Index, which ranks jurisdictions by how much financial opacity they provide to non-residents. In the most recent index, the United States ranks first. Number 1. Above the Cayman Islands, above Switzerland, above Singapore. The United States is, by this measure, the most secretive financial jurisdiction in the world. This sounds counterintuitive until you understand that the U.S. is a federal system, and corporate registration happens at the state level. And 3 U.S. states in particular, Delaware, Nevada, and Wyoming, have built an entire industry around hosting anonymous shell companies for foreign owners. Let's start with Delaware. There is a building in Wilmington, Delaware, at 1209 North Orange Street. It's a brick office building, not particularly large. It is the registered address of more than 300,000 companies, including, at various times, subsidiaries of Apple, Bank of America, Walmart, Coca-Cola, JP Morgan, Verizon, and most of the rest of the Fortune 500. 300,000. The Cayman Island house looks modest by comparison. Delaware has no sales tax. It has a unique provision called the Delaware Holding Company exemption, which allows a Delaware-registered subsidiary to hold the parent company's intellectual property and collect royalty payments from the parent's operating units in other states. Those royalty payments are deductible in the high-tax states where the operations are based, but the income received by the Delaware subsidiary is not taxed by Delaware. This is a domestic Apple Ireland setup. It's used by virtually every large American corporation to reduce state-level corporate income tax. But Delaware is now being overtaken. The state that has become the most aggressive American tax haven over the last few years is Wyoming. Wyoming has roughly 580,000 residents, fewer people than the city of Albuquerque. It now has more new company registrations per capita than Delaware. According to Open Corporate's data published in late 2024, Wyoming registered around 378 new companies for every 1,000 adult residents in a single year, compared to 268 in Delaware. The rate of new registrations in Wyoming grew 30% in 2023 alone. Wyoming has done something Delaware can't quite match, which is a structure local lawyers refer to as the cowboy cocktail. It works like this. Most U.S. states require you to name a human being as the responsible party for a trust. Wyoming allows you to name a Wyoming LLC as the controller of the trust instead. That LLC, in turn, can be owned by another anonymous LLC. By stacking these correctly, a foreign beneficial owner can be completely shielded from disclosure, even to American law enforcement, as long as the structure isn't involved in a specific criminal investigation. The mechanics are similar to BVI nominee directorships, but they're available inside the United States with no foreign banking required. There is a particular building in Cheyenne, Wyoming at 1712 Pioneer Avenue that a 2011 NPR investigation found was registered as the address of more than 2,000 shell companies. One of the mailboxes at that address belonged to the former Ukrainian Prime Minister Pavlo Lazarenko, who was at the time serving a federal prison sentence in California for money laundering and extortion. Another mailbox belonged to a different shell company involved in a Russian arms trafficking case. The mailboxes were processed by a service called Wyoming Corporate Services, which specialized in creating what it called shelf companies, pre-incorporated entities that could be aged for a few years and then sold to clients who wanted a company with an established history. In 2021, the U.S. Congress passed the Corporate Transparency Act, which was supposed to require small companies to disclose their beneficial owners to a federal database called FinCEN. The law was due to take effect at the start of 2024. In December 2024, a federal court issued an injunction blocking its enforcement. In March 2025, the Treasury Department under the new administration announced it would suspend enforcement of the disclosure requirements indefinitely for U.S.-formed companies. The federal database that was supposed to crack open American shell company secrecy was essentially shut down before it had been operational for a full year. When the Cayman Islands wants to defend itself publicly, and it does, frequently, its main argument is that whatever Cayman does, Delaware and Wyoming do worse. They are not entirely wrong about that. The Caymans actually require service providers to report beneficial ownership to a non-public registry called BOSS. Delaware doesn't, until very recently, and Wyoming still doesn't in any meaningful way. The most opaque jurisdiction in the world for anonymous corporate formation is not on a Caribbean island. It's a few hours' drive from the headquarters of the United States Treasury. So if we step back and look at all of this together, Apple's 8-year fight to defend a 0.05% tax rate, Starbucks's 14 years of fictitious UK losses, Bezos's 2 years of zero federal income tax, Messi and Ronaldo and Shakira routing image rights through Caribbean shell companies, Wyoming overtaking Delaware in shell company formation while the federal disclosure law gets suspended. You might fairly ask, what has actually been done about any of this? There's a real answer to that, and it's not nothing. Over the last 15 years, 3 major waves of international reform have been attempted. The first was FACA, the Foreign Account Tax Compliance Act, passed by the U.S. in 2010. FAC requires foreign banks to report account information on American clients directly to the IRS. It has substantially reduced the use of straightforward foreign bank accounts by U.S. persons because the banks now have a strong incentive to report. The second wave was the Common Reporting Standard, or CRS, developed by the OECD and adopted by more than 110 countries starting in 2014. CRS is essentially FACA for the rest of the world. Participating countries automatically exchange financial account information about each other's residents. The third and most ambitious wave is the OECD's Pillar 2, a global minimum tax of 15% on multinational corporations. The agreement was finalized in 2021 with 147 countries signing on, and it began phased implementation in the EU, UK, Japan, and South Korea starting in January 2024. If Pillar 2 worked as designed, it would in principle solve the Apple problem. A multinational headquartered anywhere would face a top-up tax up to 15% in its home country if any of its foreign operations were taxed at less than 15%. That should, mechanically, eliminate the value of routing IP through Bermuda or any other zero-tax jurisdiction. I say if it worked as designed, because in late 2025 and early 2026, the system was already being modified to accommodate political pressure from the United States. The current U.S. administration objected to the Pillar 2 framework on the grounds that it would subject American companies to foreign top-up taxes. In response, the OECD released a so-called side-by-side package in late 2025, which essentially carves out a special arrangement for U.S.-headquartered multinationals. Under this arrangement, U.S. companies can be exempted from key provisions of Pillar 2. Specifically, the Under-Taxed Profits Rule, the backstop that was designed to ensure no MNE could escape the minimum tax. As of early 2026, the only country listed in the OECD's central record as eligible for the side-by-side safe harbor was the United States. The architecture of the global minimum tax now has as one of its design features a door through which American multinationals can walk. And even where Pillar 2 does apply, the structure has substantial built-in carve-outs. There is a substance-based income exclusion that exempts a percentage of profits proportional to physical assets and payroll in a jurisdiction, meaning the more real activity you have somewhere, the less Pillar 2 applies. There are transitional safe harbors that defer compliance for years. There are simplified calculations available under certain conditions. None of these are sinister in themselves, but each one is a small door. And large companies with sophisticated tax teams are very good at walking through small doors. The Tax Justice Network estimates that, even with the reforms in place, global revenue losses from corporate tax abuse and offshore individual tax evasion totaled approximately $492 billion in 2024. Of that, about $347 billion was attributed to multinational profit shifting, and the remaining $145 billion to individual wealth concealment. To put that number in context, $492 billion is roughly the entire annual education budget of the United Kingdom, multiplied by 5. It is more than the GDP of Norway, every year, disappearing into the architecture. Here's the broader pattern. Every major reform of the offshore system over the last 20 years has been a partial victory. FATCA worked, but it pushed money into structures FATCA doesn't reach. CRS worked, but Wyoming and the United States effectively opted out as an enforcement matter. The Apple case worked, but only after 8 years of litigation, and the architecture has already moved to its next iteration. Pillar 2 was designed as the closing door, and one of the world's largest economies got a custom-built carve-out before the door fully shut. The reason this keeps happening isn't that regulators are stupid or corrupt. It's that the regulators are working at the speed of public legislation, while the people on the other side are working at the speed of private corporate restructuring. A tax structure can be redesigned in a quarter. A loophole can be closed only after years of investigation, drafting, legislative approval, and international coordination. The pace asymmetry is structural. As long as it exists, the architecture will keep producing new iterations. And it's worth noting how this connects to other systems we've examined. If you've watched our breakdown of how dollar dominance works, or how securitization repackages and resells debt, the underlying logic should sound familiar. The point of the dollar system, in many ways, is to keep capital flowing to the United States. The point of securitization is to redistribute risk in ways that obscure where it ultimately lives. The point of the offshore architecture is to redistribute taxable income in ways that obscure where it should be paid. These aren't separate phenomena. They are facets of a single global financial architecture in which the rules are written by people who already have capital, for the benefit of people who already have capital. Some of it is illegal. Most of it is not. The asymmetry isn't a bug. It's the design. Before I close, I want to leave you with 3 concrete things you can track if you want to follow how this story develops over the next few years. First, watch the next ProPublica or ICIJ leak. There's been one approximately every 18 months for the last decade, and each one provides a snapshot of how the techniques are evolving. Second, watch the OECD's annual reporting on Pillar 2 implementation and the side-by-side safe harbor. The key question is whether other major economies start objecting to the U.S. carve-out, or whether they start demanding carve-outs of their own, because the moment everyone has a carve-out, the framework is effectively dead. And third, watch the Wyoming and Delaware corporate registration numbers. The clearest leading indicator of how much money is being moved into new opaque structures is how fast U.S. shell company formations are growing. If those numbers keep climbing while the federal disclosure laws stay suspended, you can assume the architecture is healthy and adapting. None of this is investment advice. None of this is a recommendation to do anything in particular. It is just an attempt to describe, accurately, the system that you and I are participants in, whether we know it or not. We pay our income taxes through withholding from our paychecks. The largest corporations and the wealthiest individuals participate in the same nominal tax system, but the structures available to them, the offshore companies, the trusts, the transfer pricing arrangements, the buy-borrow-die cycle, exist in a parallel universe with different rules. When you next read that some multinational paid 0.5% in tax, or that some billionaire's true tax rate was 1%, the right reaction isn't outrage. The right reaction is recognition. The system is working exactly as it has been built to work. The architecture has been a long time in construction. It will be a long time in dismantling. The first step toward changing anything, as always, is seeing what is actually there. Thanks for watching. If this kind of long-form breakdown is useful to you, hit subscribe, and we'll see you in the next one.